Hey everybody, welcome back to the channel. I'm Satoshi Sean. Today we have a interview we're doing, a treat. We got Jonathan Libby from Steady State, which is a project that is an industry that's near and dear to me. I am not yours, but I was a financial advisor and worked with insurance. I'm still licensed for my insurance for life, accident, health, and I don't know, a couple others, but I always thought blockchain, and I've tried to help build some projects with insurance in the blockchain space and crypto, but I thought that this was you've made the comment, I've made the comment, Jonathan, that insurance has been really nothing innovative has really happened in the past probably 100 years. You know, it's one of the biggest and most regulated industries out there, but not a lot of innovation.
Yeah, no, you're right. There's not a lot of innovation. I would say probably the biggest innovation was the insurance-linked security that was released. I don't even know how long ago. And it was basically allowing insurance companies to mutual life to sell a portion of their portfolio off in their life or health side. Yep, on a reinsurance on its hedge funds and private equity. It was a reinsurance model, and there are also captive vehicles attached to captive insurance models similar to reinsurance, and it collateralized captive models together and reinsured it. A lot of the innovation in insurtech seems like UX, UI, convenient human interface, or it's really focused on alternative insurance methods, because we find alternative insurance it's more unclear what's regulated and what's not, and it allows people the freedom to see how we can make the world a better place and how we can inspire to bring the industry where it needs to be as a whole.
Now, before you run off, we're going to try and keep it simple. I know that didn't sound very simple, but we're trying to keep it simple for everybody. One thing I think about insurance, what I think is could be the most revolutionary, is in claim services. So I want to ask you a lot of questions about the claim services.
Yeah.
And one thing that people don't realize about insurance, it's a massive amount. I mean, we talk about banks all the time. And banks are terrible. Banks are powerful and huge, but insurance companies own many banks. They're like behind banks, and they're very, very huge. When it comes to government lobbies, there's things that are legal, but they're terrible. They're terrible for consumers. They're terrible for the average person when it comes to insurance, but they're completely illegal. And it's one of the things is in claims. But Jonathan, before we get started and everything, why don't you tell us a little about yourself, how you got into to blockchain, where you're coming from, and then kind of give us a quick overview of what you're trying to do with Steady State.
Yeah. So my name's John. I have been involved with insurance for about 3 years, and I got a lot of exposure during my time in that space and a lot of the Lloyd's of London. I was able to learn under former executives from the Lloyd's of London, former CFOs from AIG, and be exposed to both life, health, and P&C, and the typical kinds of insurance, but also alternative insurance such as captive insurance, reinsurance markets, and I was kind of exposed to insurtech and a lot of different other things. I fell in love with DeFi in fall of 2019. I found Pool Together was kind of the first DeFi protocol I really found. And what really blew me away about Pool Together was not necessarily the concept, which is also a brilliant concept. It was compound finance that generates interest and that is paid by the second or automatically or daily. These reward systems that pay so quickly blew my mind about how capital efficient financial markets could be in DeFi and how it could actually innovate institutional finance. That love was reinvigorated back when I found Yearn Finance in the original initiation build of the Yearn Finance, where it was a smart contract that you could deposit a DAI or USDC in, and it would find the highest paying APY on a lending protocol and move the money accordingly. And I realized how absolutely efficient that could be in a financial market for real world people. Imagine getting in a fintech bank that was attached to all these other fintech banks, and by depositing money here, it lends to the highest APY savings at all times, giving you the best possible. That showed me that literally this stuff's the future. Not only does it pay faster, it's more efficient and is more capital efficient. And I kind of realized I need to find a way to really be involved in that space. And I found, and that's kind of where we ended up coming with Steady State. In a Steady State, the goal is to really turn insurance into a financial market. I looked at insurance and DeFi and crypto, and I found kind of three major problems. During the time of my research, there was no optimal business insurance solution. And if if a protocol wanted insurance, there was often not strong enough liquidity for them to actually get the coverage they needed that was optimal. And third, if they wanted to, the claims process was very confusing, uncertain, and it was very tough for a protocol to really decide whether or not they it was tough for protocols to decide whether or not they want to get insurance, even if there's a business insurance, there's capital coverage, and there's liquidity, if they even wanted to get it, because the claims process was built on mutual systems, and there was something that that relies on human error and people being willing to give their capital over if an event happens rather than a pool, which actually falls in the same problems we have in our current claim system. What we're doing, so what we're trying to do currently is at DeFi is we're trying to make an automated smart contract claim system. The automatic smart contract claim system is what we believe to be the solution for how to solve this mutual problem or the currently insurance problem. Where a lot of the risks you won't cover in DeFi is if you put $100 in a curve liquidity pool, you're scared you're gonna wake up tomorrow and that curve liquidity pool is empty, and so is your money. Those are catastrophe events. So what we want to do is look at the risk events that happen, standardize them, automate them, and detect when the events are happening. Let a protocol deposit a proof that an event happened. Take what we call a parametric approach to ensuring it. And if it's approved by the smart contract, put it in a 10 to 15 day lockup that eventually pays to the protocol and recovers the lost amount of money.
Okay.
But rather than we insure it directly, protocols post insurance policy, if they want $20 million, you can stake $100 in that policy, and you get paid a premium rate of return on that $100 stake. And they can get a policy up to $200 million, to $20 million, sorry, if that's what they want. The goal of that is actually to balance and drive premium rates up rather than down, and for protocols to actually use this as a new solution to cover their downside, build new opportunities for the community, and also get the effective coverage they need. That's kind of the high level we're bringing forward. And we also have the index pool model, the stake swap exchange to manage the downside risk, to make the staking liquid, and how we're actually going to build as a whole. But I think we're going to focus on the claims process. So let's explain that initial coverage. That's the coverage pool method we're applying.
Well, yeah, the claims process is what I wanted, because you mentioned the word automated.
Yeah.
And how I had worked, like I said, on building we were trying to build a PNC.
Yep.
And the claims process to me should be revolutionary simple. And this is one of the areas that I talked about that's legal, but it's terrible. Now, when it comes to life insurance, let's say you're a regular person, you buy a life insurance, $100,000, $200,000. So you have your wife and your two kids, and you die. And it's after 2 years, after a contestability period, all that stuff. Simple, easy claim. Your wife submits it, and it's approved. Now she has a funeral to pay. She has all the bills to pay. The income is gone because you're not there.
Mm-hmm.
The insurance company says that claim is approved, no problem. But they can hold that for up to half a year, 6 months, and they do. It's not that they do, because that's $200,000 that they're going to get interest on for the next 6 months, versus if they give you that $200,000, they don't have it for the next 6 months. So legally, they're allowed to take 6 months to pay the claim. So they can hold that, and you still have no income, all those bills, the funeral, all that for 6 months that you have to take care of.
Yeah.
So with an automated smart contract claim, this is what I thought it should be. Just insurance in general. If you can submit a death certificate, if you can do everything to where that is approved, the smart contract should release the claim. And we wouldn't do it on a smaller scale, like for travel insurance or item insurance, that kind of thing. But like if you're in a car accident, literally, you could have had submitted pictures of your car before. You could submit a copy of the police report right there from your car at the accident, and a picture of the damage, and a smart contract could approve that and pay you your claim at the accident, literally before you leave. It could be that simple. I mean, blockchain could revolutionize insurance that much. So when you talk about automated, are you talking about something similar to that?
So the events we're trying to cover we're first trying to cover our business-to-business insurance coverage for catastrophe events. So if you
Like
look at
like
industry of insurance, we're if you look at insurance and catastrophe events in insurance, you think about often hurricanes or like a bad thunderstorm or an earthquake that impacts something, and then there's a payout there. But the industry itself is pushing actually insurance to go another route. Is technological risk should be considered catastrophe insurance.
right.
So,
Are you talking about like hacks or
yep,
that kind of thing?
bugs, flash loan attacks, hacks, exploits, oracle manipulation. And so what we're doing currently is we've built a massive database through our risk analyst database system, the RAD system. We've identified every single kind of hack that's happened. And now we're doing a lot of machine learning, linear regressions, relationship modeling to identify and standardize what kind of events what the variables that happen normally when these events occur. And basically we're trying to create a success rating of detection. And basically, because there are a lot of ways different hacks happen, what we're seeing is like there are different things that happen when these kind of events happen, such as
So it's like, are you like trying to build an actuary database, like
the first one in DeFi.
like a first one? Yeah, okay, yeah, that's pretty cool.
We're building that out ourselves, and it's getting crazier and crazier. You should see it's. I think we're going to start releasing content in the next couple of weeks about different things we're identifying and building out. But it's going to be an open source, transparent database for everyone to use. And we're going to actually use that database ideally as even though it's our own system, we're going to be acting like a client, and they're going to evaluate our own system. They're going to evaluate how we go by doing analysis and the events we detect, and people can go in and challenge that, look to add more columns, and build up the system with us. And so the goal is to build this community as a whole, and that's kind of like a goodwill we're giving to the community. Well, also, we need this to build out their whole system. And ideally, that would push all insurance companies better. How you automate this is
it could be like a foundation for a new branch of the insurance industry itself.
Amen. Yep. Yeah. And so how we can start doing that is we've actually started, we're looking at all the events that happen. And we're using machine learning, we use linear regression to decide to find out relationship models of risk premiums and new actuarial science like in that way. And what we're also doing is using machine learning. We standardize all these events. Say we've identified these events as exploits or black hat or bugs or whatever reason or flash loan. And then we run machine learning to start detecting different events in relationships to the variables that are happening. And we're finding trends. This happens, therefore event. And so what happens is we can detect, like, even though events happen differently, all these different kind of flash loans are done differently. There are things that are going on every time this event occurs, on-chain and through on-chain and actually off-chain data. And we're using all these different nodes, and we're building actually some of the first kinds of risk nodes in the industry as well to start standardizing and critique these events. What it does is it actually alerts the smart contract. We think an event's happening, get ready. And so, then when the event is ready, it's just kind of there in like a red flash. The smart contract, the smart contract is ready, it's asleep and it's turned on, and then protocols can proven transaction hashes, different kinds of data feeds, and if it evaluates proofs of standardized event. What we want to see is the smart contract identifies this event from the data provided, and the node identifies this happens because this event happened, and it's a double green light, moves forward to a 10 to 15 day lockup. That's it, 10 to 15 day lockup for a postmortem to make sure the tech was right. And then it goes back and pays the protocol, and everyone recovers their funds. Ideally, this should work well. Ideally this would work well. And what's really important to get down is a success rating and to limit the human interaction as much as possible. And when there is human interaction comes in during that 10 to 15 day lockup, where they can challenge the tech and code and it's provide proof of fraud to show that tech was wrong or that bad actor activity happened, which we would usually see in the postmortem to the protocol. And that's kind of what we're trying to solve, is we make it all tech into that lockup, and then the lockup can be evaluated, but you have to provide proof of data or proof of fraud that the tech was wrong or the bad actor activity. And we want to make sure protocols that like hack themselves don't get paid out, obviously, because this is people's money staking on the downside, covering probably arbitraging probably their own investment in the protocol, make sure that they are covered as well.
Yeah, I had read some of the stuff I was researching that you want to have as little human error or interaction until the end. Yep. You know, like all AI, all machine until the end, which is good. No human interaction makes me nervous. That is okay.
But no, yeah, absolutely no. So we actually think this is an effective measure. So the payout cannot be immediate. The reason why is you detect a flash and activity or bug is happening, and say if we made it all nodes, and the nodes detect events happening, initiate payout, the money you meant to insure against a flash attack going to the pool could literally get drained as well in the same liquidity pool. So that lockup allows people to evaluate, make sure they get the problem fixed, and then they pay them out directly. So that's kind of the goal, is what we're trying to do here, and we think it's an effective measure. And the only time the human error comes in is after the event says yes, and you actually have to provide proof that the tech is wrong, rather than you can evaluate the tech while it's evaluating.
Mm-hmm. As far as, I mean, you're based in the U.S., and like we both said, insurance is one of the most regulated areas, period, which we talk about regulation in crypto. This is like a whole new, I mean, it's a whole new headache because it's two different massively regulated industries when it comes to like money and insurance. How is this going to work? Is there going to be any kind of like licensing? Is it going to be by state, country? Because it's international. There's a lot of like weird questions that were going through my mind. Have you thought about that, or how's that going to work?
We're still evaluating the process. Make sure U.S. is the best location to do this. We want to build this in the U.S. We think this is a great solution to build for a lot of these U.S. protocol entities. How we currently see this happening is it's hard to actually figure out if we're fully an insurance product because of how we're building this out, or we're a brand new kind of financial market and who's in charge of us. And because we are a platform. We aren't insuring anything. What we do is we use the coverage pool and the index pool model in the State Exchange really to actually allow people to cover their own protocols or cover whatever protocols they want and get some kind of a great value in return for their coverage on the stake. And we can go into that if you want, but we're looking to base out of Austin, Texas, ideally. I'm starting to have some conversations, and we have some great people on the InsurTech side looking to really help us build out and make sure it's as clean as a whistle, and some great legal experts helping us evaluate this as well.
That would be really smart. Are you talking about how the new blockchain stuff that the governor just signed?
Yep.
Yeah, all that, yep. And then Austin's a good insurance hub too.
Yep.
That would be right down the road for me. So yeah, that'd be that would be smart. But that because DeFi, it's a whole new. I mean, we're part of history. DeFi is a whole new area of finance, and in like the financial industry itself. And then this is like you're literally building so many things from the foundation up when it comes to insurance. So like, what is it even called? What is it to fall under? There it is. And you're so new. That's another thing I wanted to go over the roadmap with you. Right now, you're just let me look. I also want to talk about your tokenomics. So you just did the partnership and the private development testing, and that all went good.
So yeah, we're actually pushing that off. That's not an updated roadmap. We're hoping to launch by end of Q. We're probably going to be testing, looking by September, August. Talking to the team. I didn't take into consideration delays, and that was just my own fault being a young founder. And we're looking to push off and get testnet in. A lot of steady state has been built out already well. It's we just locked in a CDO expert on the index pool model, making sure that everything is smart, correct, and good. And we also need to make sure the database is built out very sound, and the database is going to take more time than I initially intended for a couple reasons. And so I have a feeling we'll be launching MVP the end of Q4. Early Q1 2022, if I give a range.
This MVP was end of Q4, so that's around the same time.
So that's perfect. Yeah, it's we're still figuring that out. I'm going to be sitting down with my tech team, and we're just going to go over like, hey, you guys in a short period of time have built a lot of this out. Like, they're brilliant guys. They're really saying this, and this. Like, it was pretty crazy how this project, when you actually think about it, should be really complex and built out. And they're like doing the mathematical. These guys are crazy. They were doing linear algebra in high school, like Calc 3 and linear algebra. Like, these are smart guys building this project. And we're just sitting down, and they're like, they're mathing it out, and like we're working, like really thinking like how long this was done. Like, oh yeah, like we've already architected and built the backbone like in like a couple of days. I'm looking like, what? And they were like, now it's just really building it out harder and making it secure and making sure everything's built out well. And the hard part is the database and making sure we can automate these claims effectively. We haven't done enough of the machine learning standardization processing yet, and we haven't done enough linear regression relationship modeling yet to really say, well, I'm secure, we can get that. I think our success rate right now is like 83% in detection based on the models we built. I need to get my goal is to get that up to 95 to 99% before I'm willing to release a product to make sure that stakers and protocols are both taken care of well and no one is hurt at all. And the reason why this project will be a success, in my opinion, is that 95% or higher detection rate success and the index pool model.
All right. And you want to go over the different layers?
Yeah. So kind of the layers first is the coverage pool. So say a protocol is allowed by the DAO. So the DAO has to agree to let protocols build a model on here, post insurance. So we don't actually charge a premium. What we do is we charge protocols a suggested premium, and they charge and pay in whatever they want to incentivize people to stake money because we're not actually insuring it directly. So we believe a policy size should be around $20 to $30 million actually. If you look at the historical average of attacks that happen and ignore flash on attacks, because we can't insure that because we're not going to insure a business to, not flash on attacks, sorry, rug pulls. Right, rug pulls. We can't insure a business to rug themselves, obviously. But
I was going to ask about that because it seems, yeah.
Yeah, so we can go rug pulls. We're covering basically anything that's not like the business hurting their customers directly like that, because we're trying to incentivize good long-term capital markets. And we want the steady state market of approval to be like, we're insured against like, this is a good protocol and they're not going to pull that bad actor activity on you ideally, where they have more to lose than gain by pulling an event like that, such as a protocol like Curve or Uniswap or Pool Together. These ones have more to lose than gain, and you help them and you build those ones up. We want the steady swap kind of mark to be like the FDIC approval, where you have a base level of fundamental insurance that you're covered against these kinds of events, and the business is handling it, not you. And that's one of our biggest things, because right now you're in charge of insuring yourself in every single protocol you do. It's like, come on, it's like the businesses should be responsible for that. It's their code, it's their DAO, it's their business. The DAO should be running that system, not necessarily you. You should maybe get insurance on top of what they're covering, not be the fundamental layer. So the coverage pool is a protocol posts like a $20 million policy. And let's say you take a $100 policy, you get let's say it's Aave, and they are willing to pay you a 20% rate of return in Aave tokens. You stake 100 USDC because Aave accepts USDC to stake, and they're going to pay you a 20% rate of return in Aave tokens. And that's kind of the return. And so you lock that money up in a stake, and then they pay 20% return. It's actually not locked, but we'll go over that in a second. So the problem here, this is great. Okay, there's probably not a lot of places. I have to look into it. I'm just throwing Aave out as an example. But like, how many places are going to pay a 20% rate of return on Aave tokens? And Aave is paying you to cover their downside. Well, that's probably really good if you want to accumulate Aave. So you put in $100 and then you receive 20% rate of return Aave. But the problem with the coverage pool model is, say your upside is 20%, but your downside in event occurs is 100%. And so we looked at that, and I kind of looked at that. And I'm like, well, the risk is still it's probably the chances of Aave actually getting exploited is so low, but if it does happen, your downside's high. And so our question was, how do you control the downside? Well, actually maybe creating a better payout system. And so the index pool model is what we created. The index pool is like a pool made up of multiple coverage pools that have like a weighted average exposure. So let's say you have 5 protocols. Let's say yield.app, you have yield.app, you have Pool Together, you have Curve, Uniswap, and Aave. If these pools, say these 5 pools, we can opt their capital through the DAO into one separate index pool. And what this does is you receive let's say if you put $100 down there, if an event happens, your downside weighted now, rather than being 100%, is 20% in the likeliness of an event happening. But your payout, let's say, is a weighted average variable of all these different payouts, is a 25% rate of return payout in Pool, Curve, Aave, Yield, and I think it was Uni I said. So like that's the payout. So you can actually get a better payout mixtures of tokens that are paid hourly or daily for your stake. Let's extrapolate that. A top 100 DeFi index pool with a let's say this has with 1% weighted average exposure. By locking in $100 in this pool, your downside risk exposure, say if one protocol files for insurance is 1%, let's say, what are the odds that 5 protocols in the top 100 DeFi index file for insurance? It's less than 1%. So your downside in a black swan, our goal is to be 5%, with your upside being a 25 or 30% rate of return of variable average and 100 different tokens paid hourly automatically. And you can park your capital. Our kind of goal here is if you're a whale, if you put $1 million in a liquidity pool, you're at risk of losing all that money. Why not park capital here and accumulate growth in a bear or bull market? If you're a trader and you don't know what trade to make, why not park capital here and grow it and unstake when you can? And we'll go over the unstaking in a second. If you're say an institutional in finance or an institutional finance, and you don't know what trade, you know what DeFi is, the index pool model, if built correctly, is the first solution for institutional finance to really enter in and cover their downside. You would, rather than try to avoid downside, steady state acknowledges it and actually tries to control it and limit it while creating a better payout and likeliness of success. How do we make this liquid? The steady swap exchange is how we make it liquid. When you look at insurance industry as a whole, when you want to unstake, it's probably a 10 to 30 day lockup for every unstake you want to do. That lockup's there because they need to replace the capital liquidity if an event happens. So if I want to stake like my $100, it takes 20, 30 days. Why? So this is why the insurance model doesn't work well if people are opting capital, is that lockup. We need liquidity in crypto. So what market do you cover risk? And then what market we thought you cover risk, and then by opting in capital, and then it's liquid though. Well, that would actually mirror some kind of like a catastrophe bond system we looked at, or some kind of a bond system where if say someone releases $20 million in bonds, and then people can buy that bond and they receive a premium for that. But if they want to sell that bond, they don't sell back to the business. They trade it amongst each other. And we think so how do you solve then unstaking and staking liquidity insurance? Provide new capital. That's how you do it. Make the market liquid by providing the liquidity to buy and sell the stake. And that's what we're doing. So we're not like bonds, but we're likened to bond markets. We're not a bond market, but we're very similar. And we're the stake market. Yeah. And you can, so by unstaking and staking your capital, rather than unstaking it, you sell your stake for a synthetic USDC value, say, and you trade that. And so why would you provide liquidity to a market like that? Well, let's say I have a $100 stake in an index pool and I want to sell that. I go to the AMM, the first kind of we're building out the first kind of staked AMM system we're trying to build this out to be, and say we charge $99, so we'll buy that stake off you for $99. You take that, it's liquid, you get out. But the stake value is still $100. So, and then I want to go back into that. And someone wants to buy into that, they say receive $100, they pay $100 and go back into the stake. So what did I receive during that time as liquidity provider? There's a transaction fee, probably a 0.001% transaction fee. There's a difference. There's a premium difference in a sale. And also what you get is when it's being held into liquidity pool, whatever liquidity pool buys that stake, they receive the rewards as well. You're getting a triple payout. If you think about Uniswap, trading volume is the key way by you receive the highest APY premium. You make money through trading volume or through just or in slow trades. You get a base level amount. And that's what we're trying to do with the State Swap Exchange, is we actually incentivize that, making a higher reward system. It's like pushing liquidity mining through the sushi swap to the next level.
Okay, that is a very cool concept. So you don't have to lock it up. You covered pretty much everything I wanted to know about.
Amazing.
As far as are you doing the private token raise now?
Yeah, so we've actually my goal was to raise money fast, IDO, get the token out there, build the product, and build later. Market first, build later is typical crypto. And we have the builders already. We have everything moving on our end, and we have we're way oversubscribed on pledging, which has been great. But we've only taken a couple 100,000 because I had a conviction that this product, if it's built right, is a tier 1 product. It is a tier 1 solution in the industry. And my conviction is starting to hold true, where we're getting better and better partnerships and better groups of people we hope to announce soon, of people that want to work with us, help build this alongside us, provide capital as we build it. And it's getting better and better and better. And so I'm very thankful. So we're still in the private and sale raise, not because we couldn't raise the money. It's because we're trying to get the best partnerships and make sure this product gets where we know it needs to be. And I think everyone after you see it explained is like, holy, this is what it needs to be. And so we're getting the best partnerships to get us there. And that's our goal. Money's cool, but what I want are people that want to build us alongside us and people who can offer more than money. And that's our goal with Steady State. If the investors aren't as involved as you, then what's the point? And if you want to build a community and investors that are equally as involved as a team. And that's our goal here.
Sounds awesome. Well, looking forward to checking in on this later this year and see how things are going. If I could have you back on, that would be cool.
Definitely.
Like I said, it's something I've been very, very interested in. I think it's an area that blockchain is kind of made for, that has not been utilized, but innovation, like we talked about, really hasn't been part of the insurance industry in a long time. You guys leave a comment below so you're registered to win some crypto this week in the giveaway. If you've commented on this video, you'll probably be in this week's drawing and next week's drawing, because I think we're giving that away tomorrow. So, all right, John, it was good hanging out with you. It was good to learn about a Steady State. Everyone, you take care, and I will see you all in the next video.